Okay, everybody. Welcome to the March 15th edition of the Fats, Fuels, and Oils webinar. This week, we're going to be covering vegetable oils. Over the last week, we got USDA's WASDE report, and we'll talk a little bit about that. We'll also talk a little bit about some developments in Argentina and the impact that that may have on US soybean oil exports and the broader implications that that has for the price of soybean oil as we kind of continue on this theme that ultimately we might get to a spot this year where soybean oil prices need to rise to a level where we ration demand. And in thinking about the end users at each point, so biomass-based diesel producers, non-biofuel end users domestically, and ultimately importing countries, what that change in tax policy in Argentina means for U.S. soybean oil exports. But let's get started with our usual look at the forecast. The forecast hasn't changed much this week. Prices have come down over the last couple of days as we've seen a sharp drop in energy prices, and also a pretty significant drop in palm oil prices. Concerns about Chinese demand due to lockdowns that they're imposing in response to the latest wave of the pandemic are driving the losses, I think, in both energy and in vegetable oils. That said, I think if the Chinese wave follows the same pattern as waves in other countries, we would expect that case numbers will rise pretty rapidly for 4 to 6 weeks, and then they'll come down almost as rapidly over another 4 to 6 weeks. So whatever the impact on energy demand or vegetable oil demand, it's probably likely to be short-lived. Now, there are some broader concerns about the Chinese economy. But recent economic data, to the extent that you can trust Chinese economic data, suggests that maybe those concerns are a little bit overblown. And if that's the case, I would expect both the pressure on energy prices and the pressure on vegetable oil prices to be, again, relatively short-lived over the next couple of months, maybe. That said, we still haven't changed our forecast that much. You can see we still have an unusually wide forecast range because of the volatility that we've seen. Soybean oil prices were down more than a penny today, and as I look right now, they're down about 40 basis points. So the day-to-day swings are pretty big, and that tends to mean that our monthly average price forecasts have to be relatively wide to incorporate that broader trading range. We still expect prices to remain relatively well supported ahead of US planting. I think we'll know a lot more about what we expect for prices between now and in June after we get the prospective plantings report at the end of the month from USDA. That'll give us some idea of what farmers are intending to plant this year. Of course, final planting numbers will depend a lot on weather conditions during the spring. It very generally, farmers like to plant corn, so they're probably going to plant a fair amount of corn. But very generally, if it's wet in the spring, early in the spring, that tends to delay corn planting. They usually plant corn first and then they plant soybeans. So if you get a wet start to the planting season, it generally means that you're going to have more soybean acres relative to expectations. And if you don't get wet spring, if you get perfect planting conditions, you're probably going to come in pretty close to where those March prospective planting numbers end up being. Assuming that that we don't get a huge increase in soybean acres, which given what we've seen in wheat prices recently, and given what we've seen in corn prices, and again, just the fact that farmers tend to like to plant corn, that would suggest that we probably won't get a huge increase in soybean acres, despite soybean prices being relatively high. That means that typically what you see is some weather premium built into the market between now and June. Once we get to June, you start to get a sense of what the summer is going to look like. It doesn't mean that the weather pattern can't change during the summer, and you can't have a ridge build up over the middle of the corn belt, and the market needs to build in additional premium. But in a typical year, when we have sort of a regular weather pattern, prices tend to peak in June and then start to move lower as the market takes some of that weather premium back out of the market. And that's reflected in our forecast, as I've mentioned several times. Of course, we still have the expectation that we're going to get a lot of new renewable diesel capacity opening up this year, and that's going to increase feedstock demand. Although looking at, and we'll get to this in a little bit, looking at our gross margin forecast, it looks like, using our current forecasts and our forecast for energy prices, that biodiesel margins are going to come under pretty significant pressure over the balance of the year, and that could make the rationalization of biodiesel capacity occur at a much faster rate than we've been expecting. In that case, it really comes down to how quickly does renewable diesel capacity open up versus how quickly does biodiesel capacity shut down. The big unknown here still is one, whether the administration will change the mandates. And if they do, we assume it'll be focused on ethanol. We've got built in a 400 million gallon gap between anticipated ethanol production and the implied ethanol mandate. That gap would be made up with renewable or biomass-based diesel production. And so to the extent that there is some risk to our forecast for this rationalization in biodiesel capacity, that gap in those 400 million gallons is kind of that risk. If the gap is bigger than we expect and the administration leaves the mandates unchanged from the preliminary mandates that they published in December, then maybe rationalization doesn't occur quite as quickly as our margin forecast would suggest. If it's smaller, then I wouldn't say that it would probably occur more quickly than our forecast would suggest, because our forecast is pretty dramatic, but it might occur pretty quickly over the next 6 to 9 months. All right, with that, let's talk just a little bit about the change that USDA made to its balance sheets, its soybean oil balance sheets. It didn't really make many changes, but for soybean oil, it did reduce domestic use by 200 million pounds. That was a 300 million pound cut in biofuel feedstock demand, offset by 100 million pound increase in non-biofuel demand. And then they offset the 200 million pound decrease in domestic usage with an increase in exports. I don't necessarily disagree with USDA's non-biofuel demand number. I think I would like to have mine closer to where USDA's is than where mine is currently. But given what we expect for biofuel feedstock demand, it's very hard to make that number work. If you just take the trend of non-biofuel demand in recent months and kind of extend it out through the year, it's very easy to say that non-biofuel should be at 14.25 or 14.3 billion pounds. But we expect that as renewable diesel facilities open up, that there's going to be more pressure on feedstock or from feedstock demand, and that non-biofuel demand is going to slow. And so that's why we've got that difference between where we are and where USDA is. Our biofuel feedstock forecast number is what it is. USDA, I think historically has been very very cautious in their approach to forecasting feedstock demand, and they tend to come up a little bit, and we tend to come down a little bit, and usually the number ends up somewhere between our two forecasts. And I would expect that that's probably the same thing that will happen this year. On exports, USDA raised their export forecast up to 1.625 billion pounds. That is that's almost it's 275 million pounds above where we are. And I think that ultimately the thing that we saw last year was that at some point exports just shut off. We've seen strong exports, export sales data in recent weeks, and with the sharp rise that we've seen in palm oil prices, all of that makes a ton of sense. And with the news out of Argentina, I can see that you could argue that exports need to be higher than we're forecasting. That said, I think I think about exports much in the same way that I think about non-biofuel demand, which is that if you extend the recent trend, it's very easy to get to a higher number. There are 3 calculations that I do to try and see whether my export forecast is sort of reasonable, and they're kind of based on the recent trend in shipments, where we are relative to our export forecast in terms of commitments for any given week, and in just the outright pace of exports throughout the year. I take an average of those and kind of compare that to my forecast to try and say, okay, well, does that make sense or not? In most years, that tends to work fairly well. And even though that number isn't always my forecast, the movement in that number tends to mirror the movement in my forecast. So as that number goes up, I tend to raise my forecast. As it comes down, I tend to lower my forecast. This year, that number has been significantly higher than my forecast, and it would suggest, much like USDA did, that I probably should raise my export forecast. However, like I said, I think about this in the same way that I think about non-biofuel demand, and that is that as renewable diesel capacity comes online, I think that we are going to basically shut exports off at the Gulf, much in the same way that we did last year. And so I will be forced to raise my export forecast if I have to raise it at all as the data comes in. I'm not going to try and anticipate higher exports. I'm just going to increase them as the data kind of says that I really need to increase my exports. Along those lines, we got news this week that Argentina is going to raise its tax on soybean oil exports, and it's effectively going to raise it to a level so that it matches its export tax on soybeans. Historically, Argentina's tax system has favored exporting finished products rather than base products. So the tax on soybeans was higher than the tax on soybean oil, and the tax on biodiesel was lower than the tax on soybean oil. So this changes that a little bit. And along with the announcement that they were going to raise their taxes came the announcement that they were going to suspend soybean oil exports. The suspension of soybean oil exports is really just designed to prevent exporters from front running the increase in the tax rate. And so it's a temporary measure that will go away once the tax has increased, and that prevents people from calling their buyers and saying, hey, you need to, order a year's worth of soybean oil, and if we get this on the books, then we can avoid the higher taxes, or if we can ship this out, we can avoid the higher taxes. It doesn't necessarily mean that Argentina is suspended soybean oil exports. And in fact, what we've seen in recent days is the price of soybean oil for export from Argentina dropped pretty sharply over the past week or so, to the point where the US Gulf did have an advantage over the US Gulf was essentially cheaper than Argentina, and now it shifted back to where the US Gulf is more expensive than Argentina. If you just take the news at face value and you hear Argentina is increasing tax rates and suspending soybean oil exports, again, you can make the argument that US exports probably need to be higher than we're forecasting. But if you look at the prices, it would suggest that buyers will favor Argentine exports. The broader question of whether importing countries will buy soybean oil or palm oil has also shifted recently. And what we saw, a couple weeks ago, was that palm oil prices had a premium to soybean oil, at least for the nearby contract. And now what we've seen, especially over the last week or so, is we've seen that that spread between soybean oil and palm oil prices has started to go back up, where there's a premium for soybean oil. The nearby premium is back to even a little above even. Deferred premiums are closer to 10 cents a pound, which is higher than the long-term average, which is 4 or 5 cents. So again, that's another situation where you might look at the price for palm oil, and it hit a record last week, and you'd say, well, importing countries are probably going to favor palm oil over soybean oil. US soybean oil exports should be higher. But now that that spread has started to shift back again, I think that argues for holding the line where we are in our export forecast. Now, our export forecast might ultimately end up being a little bit low, but I don't necessarily think that we are going to make up the difference of 275 million pounds to where USDA is. And I think ultimately they're probably going to have to lower their export forecast over the coming months. Despite the fact that USDA didn't change their ending stocks forecast, they still raised their price forecast by 2 cents to 68 cents. And this is a price forecast for crude degummed soybean oil in central Illinois. Despite the increase, we still are 4 cents above where USDA is. And what we saw this last week in soybean oil prices and in the various soybean oil prices is something that hasn't happened in a little while, which is futures prices actually came down a little bit, but basis rose to offset that decline. And so crude degummed prices actually went up. Crude degummed prices at the Gulf went up, and RBD prices really went up quite a bit. RBD basis went up 6 cents. And then I think the basis at the Gulf went up 2 cents. And I think basis for crude degummed in central Illinois, I think it went up 4 cents, but maybe it was 3 cents. Don't take me 100% on that 4 cent. I'm sure about the 6 and the 2. That just shows that domestic demand for soybean oil remains really strong, which is another reason, again, that I think that that U.S. exports are probably going to get shut off at some point. If we're already seeing RBD basis jump 6 cents in a week, and we really aren't at the point where we're opening up a bunch of new renewable diesel facilities, then you can imagine what might happen to RBD basis and crude basis when we do start to get those facilities open and we start to really put pressure on all of the feedstock markets. Okay, let's look at our biomass-based diesel gross margin. And this chart is going to look a little strange. I will say, just from the outset, I was a little surprised at what this showed. What you have is you have a situation where over for the last week of real data, we had a huge jump in energy prices that more than offset increases in the feedstock prices. So you had profitability for renewable diesel and biodiesel production uh, actually go up, even though, again, oddly, this chart doesn't. I don't know why I always have problems with this chart. In the data, it shows that the profitability went up for a week. Beyond that, we've obviously had a big move down in energy prices over the past week. And so our energy price forecasts have come down quite a bit relative to the reported numbers last week. And our feedstock price forecasts haven't really changed that much. So it really puts a lot of pressure on margins. And right now we're forecasting that renewable diesel margins fall from about, call it a little bit above $2 a gallon right now to down to something crazy like a $1.25 a gallon or something. And we have biodiesel margins going from -5 cents basically down to like -90 cents. I think those margin projections are probably a little pessimistic, or maybe even a lot pessimistic, in part because I think if that really does happen, we're probably going to get a much, again, biodiesel capacity is going to be rationalized much more quickly than we've got built into our production numbers, and that shutdown will restrict the supply of biodiesel and raise renewable diesel prices to the point where renewable diesel margins will be significantly or substantially higher than we're forecasting. And I think that sort of the same thing is likely to happen with biodiesel. If you take a bunch of biodiesel capacity out, obviously biodiesel supply goes down and prices go up. And even if you have feedstock prices that match what we're projecting, you still have better margins than we're projecting. So I think the idea that the trend is probably lower from here makes sense. I just don't know that I think that that the scale of the decreases that we're predicting makes a lot of sense right now, just because we're in this weird spot where energy prices went up so much and now they've come down so much. Again, I think I said this a week or two ago, that if there was some resolution to the Ukrainian conflict, which obviously there hasn't been, that prices could come back down, energy prices could come back down to the level that they were at before the war started and then start to work back higher. I think that we're getting that just sort of without the resolution to the conflict. So again, I think our margin forecasts are probably a little bit pessimistic relative to what we are likely to see. RIN prices dropped pretty sharply over the past week in reaction to stories suggesting that President Biden's administration was considering lowering the mandates to make compliance more affordable. They sold off pretty sharply and they've come back a bit. The impact of that was our forecast got lowered a little bit, but still remain. We still expect RIN prices generally to move higher over the balance of the year. And again, we expect the spread between D6 and D4 to narrow because of this 400 million gallon gap. As I went through it today, I think we've got the spread going from, call it 25 cents per gallon down to about 15 cents per gallon by the end of the year. We're going to continue to watch prices, and if that spread turns narrower than we expect and the Biden administration doesn't change the mandates, I think we probably will start to narrow that spread in our forecasts a little bit more than it is currently. the big increase in RIN prices really is more reflective of our expectation for feedstock prices than it is kind of anything else. But again, if we start to narrow the spread between D4 and D6, that will also start to support prices. And I would say that there's probably, even though our forecast is pretty optimistic on prices right now, I would say that that probably would be significant upside risk to our forecast, and that we could potentially take out the highs that we saw last year in RIN prices. All right, on to our LCFS credit price forecast. That also didn't change over the past week. LCFS prices are still moving lower. We didn't change it from last week, but at the pace that LCFS credit prices are moving down, I could expect that we might end up lowering our forecasts here over the next couple of weeks. We still have sort of 115 as the bottom. But again, given what we've seen in terms of the movement of LCFS credit prices recently, it wouldn't surprise me that if in a couple of weeks we've got a bottom that is a little bit lower than that. The next level down would probably be 100 for a bottom. And then ultimately, we still do expect LCFS credit prices to start to work higher in 2023 as CARB makes it more difficult to generate credits and makes it easier to generate deficits. If we look at our projected credits versus deficits for 2023, they're pretty even, which is kind of where we've been historically, versus 2022, where we expect a lot more credit generation than we do deficit generation. So at least for the foreseeable future, we expect LCFS credit prices to remain under pressure. But then again, it looks like there's probably going to be a change in the trend in 2023. All right, with that, I will open it up for questions. I see there are some questions. Are you predicting at all in your forecast a large effect due to the cost and availability of fertilizers on yields? That is a tricky question. So I think that it's hard to quantify exactly what the impact would be. If you just told me that in any year, if you told me that fertilizer prices were going to basically double, what do I think the impact of that would be? One, I would say that I would think farmers would want to reduce risk, and to do that, I think that would mean that they would plant less corn and more soybeans, because corn is more fertilizer intensive than soybeans. Now, that's kind of what I expected a little bit this year, given not only the situation with fertilizers, but also the fact that soybean prices were so high, and you've got all this demand coming for soybean oil. So it seemed like the risk reward balance had really shifted towards soybeans. But as I mentioned, farmers love to plant corn. And in speaking with several large farmers and more importantly, somebody that speaks to quite a few farmers, I was surprised to learn that most of them had not radically altered their typical rotation, and were expecting to plant more corn acres than I would have expected and fewer soybean acres than I would have expected. I lowered my my soybean planted area for 2022-23 from 91 million acres down to 89 something, which is a pretty big cut, obviously, in part based on those conversations. Now, in terms of the impact on yield, the reason that it's really hard to figure out what the impact is going to be is because um, if farmers maintain a good rotation, the main fertilizer that corn needs is nitrogen, or I guess the biggest bang for corn yields is from nitrogen application. In general, corn takes nitrogen out of the soil, which is why it requires nitrogen fertilizer, and soybeans put nitrogen back into the soil. So if a farmer can plant corn on ground where he's grown soybeans for a year or two, it really reduces the amount of nitrogen that he will need to apply throughout the year. Now, it doesn't mean that he doesn't need to use any. It also doesn't mean that the shortage of other fertilizers won't have an impact on yields. However, it's very tough to kind of say that, okay, as fertilizer prices double, that means that we take 0.3 or 1 or 5 bushels per acre off the corn yield, or we change the soybean yield this way. I think it's fair to say that in general, you would expect that there would be lower yields because of the reduction in fertilizer application, but it's just something that seems very hard to predict. A couple of weeks ago, USDA held their annual agricultural outlook forum, and in that they released their latest cut. It's really sort of their second cut at the 22-23 balance sheets, and in that they basically use a trend line yield for both corn and for soybeans. Now, that trend line was a little bit below what we were forecasting as a trend line, but I don't think that that is due to the fertilizer situation. I think that that's more just the trend line yield depends a lot on what period you picked for the trend, and the starting date can have a big impact on what the trend line looks like for the next year. So I assume that they just used a different period than we did. I think once USDA releases their initial cut at 22-23 in the WASDE report, which will occur in May, I think that they probably will incorporate whatever they think the impact of fertilizers is going to be on yields in that report. And quite honestly, I probably will adopt something that is relatively close to what USDA says, just because for stuff like that, USDA has more resources than I have, and better knowledge than I do on the impact of fertilizers on yields. And so I'm not saying that I'll take their number exactly, but I am saying that if their trendline corn yield was 181 bushels per acre and their May WASDE forecast is 172 bushels per acre, then I will probably lower whatever I'm using for trendline for corn, and similarly for soybeans. That was a very long way of kind of saying, like, it's something that is not we don't get that down into the details of yield forecasting at this point. And so I don't have a great handle on it, and I probably will rely a lot on what USDA does to try to understand the impacts of the rise in fertilizer prices and the reduction in fertilizer availability on my forecast. Can you explain again how the D4, D6 spread affects overall RIN price levels? Okay, so most of the time, I think that D4 RIN prices reflect the cost of feedstocks. In the model that we use, we have basically two inputs, or two major inputs in our D4 forecast. And one of those is the spread between soybean oil and heating oil, the HOBO spread or BOHO spread, depending on how you say it. And the other is the D6 RIN price. So if people aren't concerned about the ethanol blend wall, that is, if people don't expect that ethanol production is going to fall short of the ethanol mandate, then I think that that D6 component to the model is really not as important as the spread between soybean oil and heating oil. And I think that you could argue that the correlation between that spread, or more broadly between feedstock prices and RIN prices, is very, very high. When you get into a situation where people are worried about the ethanol blend wall, what happens is there is a shortfall in ethanol production relative to the ethanol mandate. And just to kind of go back a little bit, ethanol is used as an octane booster. It replaced MTBE, which was leaking into groundwater. And what it does is it boosts the octane rating of gasoline, so that the fuel in the cylinder doesn't spontaneously combust. And that is something that's a risk that goes up as pressures for combustion go up in engines. And in modern cars, pressures in cylinders are much higher than they have been typically. So there's a real need for ethanol, but there isn't a need for ethanol beyond whatever that need is. So the government can mandate 15 billion gallons of ethanol production, but that doesn't mean that that drivers are going to need 15 billion gallons of ethanol to meet the demand, or I guess blenders aren't going to need 15 billion gallons to meet the demand. We predict, based on the EIA short-term energy outlook, that ethanol production is probably going to shortfall about 400 million gallons short of that 15 billion gallon number. When that happens, what people do is they produce more D4 RINs, because the way that the RIN program is set up, RINs are nested, and so D4 RIN can meet the overall any individual blender's overall RVO, so it can effectively replace the D6. But what they kind of really do is they produce the D4 RIN, they sell the D4 RIN, which is more valuable than the D6 RIN anyway, and then they buy the D6 RIN to meet the overall mandate. That process has the effect of narrowing the spread between D4 and D6. But it also has, because there's that 400 million gallon shortfall in between ethanol produced and the ethanol mandate, that is made up by biomass-based diesel or other D4 production. That means that biomass-based diesel production is going to go up. You would think that that would mean that there would be more RINs available and it would pressure the price, but because you can use the D4s to satisfy the overall demand, it also means that D4 RIN prices also go up. It's not super straightforward, and it doesn't happen a lot, although it did happen last year, and it looks like it's going to happen this year, and maybe for the foreseeable future, depending on the adoption rate of electric vehicles. But in very simple terms, I think the way that you can think about it is that because there's a shortfall in the real demand for for ethanol, all of the RIN prices are going to go up because generally there's a shortfall in the economically viable production of RINs relative to the mandate. It doesn't mean that producing biomass-based diesel won't be economically viable. It just means that we won't produce enough ethanol to meet the mandate, and so the demand for both RINs goes up. And if you look historically, if we look at the historical RIN price series, both D4 and D6, you'll see that when that spread narrows, that the price for both tend to go up. I hope that was clear. It's not a super clear topic, and again, most of the time it's not something that that you have to think about. But if you think about it in really simple terms, that the D6 RIN price is an input to our model for D4 prices, and there's a shortfall in ethanol production relative to the mandate, means that D6 RIN prices are going to go up. That means that that just simply that D4 prices are going to go up too. And as that spread narrows, it implies a greater concern about the ethanol blend wall and pushes both prices higher. All right, that is it for this week. I hope everybody has a great weekend, and we will see you back here next week when we will cover the fats and grease markets. Thanks, everybody.